Have you ever wondered what would happen if your car suddenly needed major repairs? Your furnace stopped working in the middle of winter, or you were hit with an unexpected medical expense? For many Canadian seniors living on CPP, OAS, and GIS benefits, one surprise bill can put enormous pressure on a carefully planned retirement budget. Today we're talking about one of the most important topics in retirement planning that doesn't get nearly enough attention: emergency funds. How much should seniors really have set aside? Is it even possible to build savings while living on a fixed income? And what can you do if you haven't started yet? Stay with us, because this information could help protect your financial security and give you greater peace of mind. Hello everyone, and welcome back to Canada Pension Pro. If you're already retired, approaching retirement, or helping an aging parent manage their finances, today's discussion is especially important. Many Canadians spend years planning for retirement income through the Canada Pension Plan, Old Age Security, workplace pensions, and personal savings. But even the best retirement plans can be tested by unexpected events. An emergency fund acts as a financial safety net. It can help cover expenses that don't fit neatly into your monthly budget and prevent you from relying on high-interest debt during stressful times. Today, we'll explain how emergency funds work for seniors, how much may be appropriate to save, and practical ways to build and protect those savings, even if your income mainly comes from government benefits. Unlike CPP or OAS, there is no official government rule that tells seniors exactly how much they should keep in an emergency fund. Financial experts often recommend maintaining enough savings to cover 3 to 6 months of essential expenses. However, retirement can look very different from working life. For seniors living on predictable monthly income, such as CPP and OAS, the amount needed may depend on personal circumstances. Factors include whether you own or rent your home, your health situation, whether you have family support nearby, if you still own a vehicle, whether you have private insurance coverage, the stability of your monthly expenses. The key message is simple: emergencies still happen after retirement, and having a plan can make all the difference. Detailed breakdown. Who is affected? This topic applies to nearly every retiree, including CPP recipients, OAS recipients, GIS beneficiaries, seniors with workplace pensions, retirees relying mainly on personal savings, older adults preparing to retire within the next few years. Even those with modest incomes can benefit from having some emergency savings available. What counts as an emergency? An emergency fund is not intended for vacations, gifts, or everyday shopping. Instead, it may help cover expenses such as major home repairs, appliance replacements, dental emergencies, unexpected travel due to family illness, vehicle repairs, medical equipment not covered by insurance, temporary caregiving expenses, higher utility bills during extreme weather. These situations often arrive without warning. How much is enough? There is no one-size-fits-all answer. For example, a senior whose essential monthly expenses total $2,000 may aim for savings equal to 3 to 6 months of expenses. That could range from approximately $6,000 to $12,000. However, some retirees living primarily on stable government income may feel comfortable with a smaller emergency reserve. Others with greater responsibilities or health concerns may prefer a larger cushion. The most important step is identifying what amount would help you handle unexpected situations without creating financial hardship. What about GIS recipients? This is an area many viewers ask about. Guaranteed income. Supplement recipients often have very limited room in their budgets. Building a large emergency fund may not be realistic. In those cases, even small savings can help. Setting aside $10, $20, or $50 each month may gradually create a reserve that reduces future stress. Progress matters more than perfection. Possible advantages. Having an emergency fund may reduce anxiety during difficult situations, help avoid credit card debt, protect retirement investments from early withdrawals, support independence, provide flexibility during family emergencies. Possible disadvantages. It's also important to consider potential drawbacks. Keeping too much money in low-interest accounts could mean those funds lose purchasing power over time because of inflation. Some seniors may also sacrifice necessary spending in an effort to save aggressively. Balance is important. Emergency savings should provide security without compromising essential needs today. Important dates and government statements. At this time, there are no official federal requirements regarding emergency fund amounts for retirees. Government pension programs provide monthly support based on eligibility rules, but they are not designed to replace emergency savings. That means personal preparation remains an important part of retirement planning. Real-life impact? Let's look at a few realistic examples. Imagine Margaret, age 72. She receives CPP, OAS, and a modest workplace pension. Her furnace suddenly stops working during January. The repair costs over $1,000. Because she has emergency savings, she can address the issue immediately without borrowing money. Now consider David, age 69. He relies mainly on CPP and GIS. His car requires urgent repairs so he can continue attending medical appointments. He has managed to save a small emergency fund over several years. While the expense is stressful, those savings help prevent him from using high-interest debt. Finally, think about Linda and George. They're retired homeowners who support an adult child facing temporary financial hardship. Their emergency reserve gives them options without disrupting their monthly retirement income. These examples highlight that emergencies don't discriminate based on age, income level, or retirement status. Presenter. Commentary. In my view, this is one of the most overlooked aspects of retirement planning. Many Canadians focus heavily on maximizing CPP or deciding when to start OAS, which are certainly important decisions. But financial resilience often comes down to how prepared we are for the unexpected. This could be particularly important for seniors who rely heavily on monthly pension income. Unexpected expenses rarely arrive at convenient times. An emergency fund won't eliminate every challenge, but it may provide breathing room and preserve dignity during stressful moments. It's also worth remembering that retirement planning isn't only about numbers. It's about confidence. Knowing you have a small financial cushion can improve peace of mind and reduce worry. Practical advice. So, what should viewers do? First, review your monthly essential expenses. Include housing costs, groceries, medications, transportation, utilities, and insurance. Second, determine what amount feels realistic. Don't become discouraged by large targets. Even a modest goal is a positive step. Third, automate savings if possible. A small transfer into a separate savings account each month can build consistency. Fourth, keep emergency funds accessible. You don't want to face penalties or long delays when funds are needed. Fifth, review available supports. Some provincial programs, community organizations, and health-related assistance initiatives may help reduce unexpected costs. Finally, stay informed through official government sources regarding updates to CPP, OAS, GIS, tax measures, and senior assistance programs. While emergency funds remain a personal choice, government policies can influence your overall financial picture. And remember, everyone's situation is different. If you're unsure how much is appropriate for your circumstances, consider speaking with a qualified financial professional who understands retirement planning. Let's quickly review today's key takeaways. Emergency funds remain important even after retirement. There is no official government rule regarding how much seniors should save. Many experts suggest aiming for approximately 3 to 6 months of essential expenses, but the right amount depends on your circumstances. Even small contributions can build meaningful protection over time. Emergency savings may help cover unexpected home repairs, medical expenses, transportation costs, and family emergencies. Most importantly, preparation can provide confidence and flexibility during uncertain moments. Retirement isn't about avoiding every surprise. It's about being better prepared when surprises happen. If you found today's discussion helpful, please take a moment to like this video and subscribe to Canada Pension Pro. We work hard to bring you trustworthy updates, practical retirement guidance, and clear explanations about CPP, OAS, GIS, and the issues that matter most to Canadian seniors and their families. And now we'd love to hear from you. Do you currently have an emergency fund, or are you planning to start one? How much do you believe retirees should keep set aside for unexpected expenses? Share your thoughts and experiences in the comments below. Your insights may help fellow viewers facing similar decisions. Thank you so much for watching Canada Pension Pro. Take care of yourselves, stay informed, and we'll see you in the next video.